Assalamu alaikum friends, welcome to the last question of your SBR revision kit from your Kaplan revision kit, which is your lucky dairy. Question number 56. In this question we are going to cover a unique standard which is not often asked, which is IS 41. Looking at the word cows and all those things, you should be able to make a idea that this standard is regarding IS 41. Okay, so the directors would like advice on how the herd should be accounted for. Accounted for means how you're going to recognize and measure. That is the meaning of it. In his primary financial statements. Primary financial statements are statement of financial position and statement of profit and loss. Cash flow is also included, but if they specifically tell about it, then otherwise you don't include because it's for 6 marks. And advice about disclosure note is not required. Okay, what you have to disclose, what you don't have to disclose, not needed. Okay. Second is regarding IFRS 9. As I can see, the directors would like advice on how the above information will impact the carrying amount of his financial asset for 8 marks again, 6 and 8 marks. Now, part B. This is regarding your two things: cash flow statement, statement of cash flow, and integrated reporting. See, integrated reporting and statement of cash flow, they can give you in section B, question number 4, to analyze a company. Okay, because through integrated reporting and also through statement of cash flow you can analyze a company. That's why the 2 professional marks is given here, and this is for 9 marks, by the way. So this marks are huge marks. Okay, discuss to the extent to which statement of cash flow provides stakeholders with useful information. That means what are the information that you can extract from statement of cash flow? Operating activity, cash flow from finance, and investing. So out of this, which one is of a particular interest to the stakeholder? Second, whether this information would be provided by the entity introducing an integrated reporting, whether the same information will be there in the integrated reporting also or not. Of some further information that is not there in the statement of cash flow, whether it will be provided in integrated reporting. So 9 marks. Now, this question you can answer in any order. Okay, part A or part B, because B is totally related to unrelated to part A, the 2 requirements. But first let's finish with the integrated reporting. The first requirement, that is IS 41. The Lucky Dairy, a public limited company, produces milk for supply to various customers. Is responsible for producing 25% of the country's milk consumption. Company owns cows and heifers. Heifers are young female cows. Okay, herd as of 31st May 2002 compromises 3-year-old cows and 2-year-old heifers. That means the young female cows. All purchased before 1st of June 2001, and these are purchased for 46 each on 1st of December 2001. Okay, this is before 1st of June 2001. There were no animals born or sold in the year. Born means, see, you are adding it. Okay, when you are sold, you are deducting it. So the per unit value less estimated cost to sell were as follows. Because when under IS 41, how do you recognize, how do you measure? Fair value less cost to sell. That's why they have given in the fair value less cost to sell already. 50, 55 and 60. This is for all on 31st May 2001, 2-year-old, 2-year-old on 31st May 2002, and 3-year-old on 31st May 2002. Okay, 55, 55, sorry, 50, 55 and 60. This is per unit, mind you. You don't know how many cows are there, how many units. Per unit, it's one for 1 unit, not the total unit. So what is biological asset? What type of cow, what type of asset are they? Biological asset. And if you see, there are working also to that. So for both calculation and your writing part, you're going to get 6 marks. Okay, which standard? 41. So according to this biological asset, which is in this case a dairy cow, how do you initially measure it? Fair value less cost to sell. Initially you measure it at this. And what about remeasurement? Everything that gets measured needs to be remeasured also. So it should be remeasured at each reporting date to its fair value is estimated cost to sell. Again, fair value you are taking, but this time the cost to sell are estimated. It didn't take place when you're remeasuring. And what about gain or loss? Because when you remeasure, gain or loss will come. So gain or loss are remeasured in the statement of profit and loss. Are recorded there. Okay, profit and loss only. Very simple. This is the knowledge part you are giving. facts from IS 41. How do you measure, remeasure, and gain and loss? Now we are moving on to the date. Okay, you need to write also what you have calculated. So as at 31st May 2001, herd will be having a carried in the statement of financial position. Remember the primary financial statements you have to talk. What are the primary financial statements? Statement of profit and loss and statement of financial position. At that, in these two places, what is the amount that should go? So herd is an asset, biological asset, that will be carried in the statement of financial position at this amount, 3.5. How? Working is here, 3.5. This is the carrying amount. Then heifer which is purchased, one is cow. Okay. Herd purchased in the current year should have been recognized at this amount, 1.15. That is this. They have purchased. And at the year end, the herd is revalued to its fair value less cost to sell, that is 5.58. That is this amount. And a revaluation gain. It's a gain of how much? 0.95. This will be recognized in profit and loss. Always write the place where this will go to, where it will be recognized. And that 0.93 is this, the balancing figure. Okay. Clearly they have signposted that it is under working one. Then comes your working one. This working one you can do it in Excel or in Word, it's up to you. But I always say Excel is better, it's faster. Okay. Anyway, it's a small calculation. It can be done in Word also. It's okay, not an issue. First, always start with the current and then 31st May 2002, opening and closing. Okay. So opening will be how much? 70,000 into 50. How 70,000 into 50? This 3-year-old. Okay. And this is the amount for 50 for 31st May 2001. Okay. See, they told 2-year-old animal. Okay. Definitely in this 70,000, 2-year will come. In this 3 years old means 2-year will definitely come inside that. Understood? So 70,000 into 50. Okay. Then you're purchasing what? The heifer 25,000 into 46. It is this that you're purchasing. 25. And this will be into what? 46. Because they told purchased. Understood? On 1st December 2001. So that's your purchasing into 46. Fair value is a balance figure. We'll leave it, and closing amount is how much? 70 into 6 plus 25 into 50. You see the price changed. Obviously this 70,000 will go opening balance, this one, and this purchase 25,000 also will be there, this heifer also. Only the price will change. This becomes 60, this becomes 55. We'll see how. Why it becomes 60? Because at the year end, 3-year-old animal. Okay. The 70,000 will be at this. This is the amount. Okay. Closing balance. And for 2-year-old animal, that is the heifer, on 31st May 2002, it is 55. Okay. This is basically to get the price per unit. That's why you need. Okay. And for first one, again, I'm repeating 70 into 50 because this 2-year-old animal. Okay. In this 3-year-old cows, 2-year-old animal also will come. Okay. Because you already have one price that is for 31st May 2001 and you need that opening balance. That's why even though it says 3-year, you can use this in the opening balance. Okay. Look at the date. Date matters a lot. So that's how. And balance is a fair value gain. Because I've told you this is an asset, value went up at the year end. Just add this to and see. 3.5 plus 1.15. It will be less than 5.58 only. That means closing value went up. It's an asset, so it's a fair value gain. Now we are moving to the next one, financial asset. So we'll read the things for second one. It is for how many marks? 8 marks. They purchase interest bearing bonds. What did they purchase? Interest bearing bond. Remember, in Jax it's a company. Interest bearing bond. What type of instrument is it? It's a financial asset. What type of financial asset? There are two types: equity based and interest debt instrument. This is a debt instrument because interest bearing. Anything to do with interest is debt instrument, whether bond or loan or whatever. So they are having a financial asset, debt instrument. Okay, they purchase this. Okay, in another listed company. In Jack is another listed company. There they have purchased this. For how much? 10 million. And classify this assets to be measured at amortized cost. Yes, possible. Debt instrument, amortized cost you can do. Just before the date of the bond purchase, they have released an interim financial report that demonstrated encouraging year-on-year growth. You need this facts and information whenever they talk about what do I say? Circumstances related to the company. For example, how is their performance, how is the market doing, whether they are growing, whether they are declining. These are very important facts for your answer. It looks like that is not so important. They are just giving their background or environment of that. It's important in your answer. Why? Because these are indicators whether your financial asset is impaired or not. Any type of asset, whenever they give information, they are giving you a sign whether it is impaired or not. That's why they are telling you. So year-on-year growth is there and a strong financial position. As such, external agencies had graded the bond as having a low credit risk. Now something comes up in your mind, pops out, that this is actually regarding impairment of financial asset. Be prepared for this topic as well. So in May 2002, they released annual financial statements and this showed a weak trading performance in the final 6 months, as well as a large decline in cash generated from operation also compared to the prior year. The financial statements show that at the period end, they were relatively close to breaching his loan covenant. The listed bond price of Jack has fallen by 20%. Bond price, despite an overall increase in bond price for other listed entities in the same sector. Other entities, if you see, their bond price increased, but this fell by 20%. It's not a good sign. It has been reported that external agencies are reviewing and reassessing the credit ratings, and despite encountering financial difficulties, they have met all their obligations to its lenders and bondholders. It's quite surprising. You have to keep a skeptical mind, right? Professional skeptical. In audit, you must have heard this word. So, whenever you are doing SBR also, you have to be very alert that something is very fishing, something is not all right, because you are having such financial difficulties and still you are meeting the obligations. It's quite surprising. Okay, how financial assets will be carried forward. So this is talking about impairment. Okay, so in your answer also you have to talk about impairment for 8 marks. Which standard? IFRS 9. Immediately loss allowance. Why? Because impairment. No need to tell define financial asset is this and it's a debt instrument because it's interest bearing. All this are not needed. Pick up the standard, immediately tell the things. Pick up. The reason is loss allowance. So loss allowance should be recognized on financial asset when the debt instrument and which are measured at amortized cost at fair value through other comprehensive income. Or there's a or. In these two conditions, you have to recognize a loss allowance. What is it? When debt instrument, like in this case, measured at amortized cost or fair value through other comprehensive income. If it is fair value through profit and loss, no loss allowance. Okay. This is I've explained in my lecture also in financial asset when I was explaining the impairment of financial asset in that lecture. So 1 mark out of 8. Now we'll talk about it. What are we going to talk about it? Whether credit risk increased significantly or not. This is our main theme. If it increased significantly, how we are going to calculate the allowance. If it is not increasing significantly, how we are going to calculate the loss allowance. That's it. So if the credit risk of the financial asset has not increased significantly since inception, that means from the date, then loss allowance should be equal to 12-month expected credit losses. And if it increased significantly, then lifetime expected credit losses. That is the only difference. If did not increase significantly, 12 month. If increased significantly, lifetime expected credit loss. Okay. The entity must use reasonable forward-looking information when assessing the level of credit. See, when you want to assess the credit risk of a company, always look the forward-looking information. Don't look at past. Don't look at the budgets. Backward information is not needed. Because credit risk will change in the future only. Something that keeps on changing in the future based on the forward-looking information. Understood? Another 1 mark for this. Now, bond had, if you read the case study properly and you can recall, they have a low credit risk at the inception, opening. That time, low credit risk. Later, if it change, we'll talk about it. But From that day onwards, it increased significantly, the credit risk. Why? Because of the following. So for this following, we are going to get marks. Already 2 marks you got out of 8. Let's say another 4 marks. So 6 marks and 7. Or maybe 7 or 2 marks here. That's 2 marks here. So 1, 2, 4 and another 1 mark. So that will give you 8 marks. You should know how to collect points. Now we are moving to the next 4 points. Why? How can you tell credit risk increase significantly or not? That is the question about. They have given you so many facts. When a particular case study is giving you so many facts about something, okay, that means they are pinpointing that the question is regarding this area only. What area? Why? How can you tell that it increased significantly? That is the question about. So these are the facts. Just list out the facts from the case study. If you see here, what is it? They're giving more and more facts rather than they didn't give you allowance. So you don't have to calculate impairment or allowance or anything like that. Okay, they just told low credit risk at inception, but later on they didn't tell whether it increased significantly or not. They just told weak trading performance, large decline in cash generator, breaching in low, close to breaching in loss covenant. All those things in your answer you can now put one by one, one by one. First is regarding cash generation. Financial performance, both financial performance and cash generations are poor. So because it's poor, what does it mean? That means it has impaired his ability to service his finance obligation. That means they might not be able to pay their interest or debt amount of the loan. Because how are you going to pay the amount of loan when your financial performance is not good? When your cash you are not generating. Through that cash only you are going to pay the loan. No. Second, entity were close to breaching loss covenant at the year end. This is also another sign that increased significantly. That credit risk increased significantly. In other words, the question should be like this phrased. Directly they didn't ask you, indirectly they are asking you. What is the question should be? What are the indicators that credit risk increased significantly? That's what the requirement is all about. But they will never ask you straightforward things like this. You need to pick out. Okay. So, a breach of covenant. Okay, when you're breaching the loan covenant, remember, would potentially make loans repayable. Immediately, you might have to pay the amount of loan. So, if you have to immediately pay the loan because you are breaching the covenant, it will have an impact on the cash flow. Detrimental impact, negative impact. Third, bond price decreased 20% compared to market and the industry. So, this is also entity specific for that entity. And therefore reflective of market concerns about Jack's and his credit risk. It will show the investor that this is uh, not good for the investor. They consider this as a risky. Credit risk might increase because bond price reduced. Fourth, external agencies, their ratings. So they are reviewing the credit ratings of Jack's. Their review means what? Suggesting that credit risk has increased since the publication of his latest financial results. See, when you're reviewing something over and over again, means something is there is something fishing there. Otherwise, they will not review. They will review once and they will give their conclusion. Based on that only, they will give a rating. But now they are reviewing it again. Okay, so these are the 4 indicators on the case study only. Pure application from your knowledge. Okay, here knowledge will not help you. Okay, so now, due to the increase in credit risk, how are you going to recognize this financial asset? Because credit risk, now you can say, okay, because credit risk increased, the loss allowance should be equal to lifetime expected credit losses. Understood? Now you are saying it. Now you are giving a conclusion. Earlier you were just listing it. That if credit risk increased significantly, loss allowance will be equal to lifetime expected credit losses. Now you are giving that conclusion based on this 4 facts. So increase or decrease in allowance will be charged to profit and loss. Whether your allowance increase or decrease, it will keep on increasing or decreasing depending on the changes. It will be charged to profit and loss. So that's it for that. Now we are coming to the statement of cash flow for part B. Okay, you'll be having 2 separate. One is integrated reporting, one is statement of cash flow. Okay, remember the way you present. Okay, you are going to get the 2 professional marks. Out of 2, 1 professional mark you are going to get for the presentation and the other one for the quality of your discussion. Okay, now let us read. The editors have been reviewing the IFRS for integrated reporting. The editors believe that they are already extensive and provide stakeholders with a comprehensive understanding both of the financial position and performance. Statement of cash flow enables stakeholders to assess the liquidity, solvency, and financial adaptability. They are concerned that any additional disclosure could be excessive and most useful information might be hidden. Okay. They are therefore unsure as to the rationale for the implementation of a separate or combined integrated reporting. That's why they think that it's not rational. They're very unsure whether it's rational also or not. That a separate or a combined integrated reporting should be implemented or not. Now you have to give reasons why they have to implement an integrated reporting, or if you are against integrated reporting, you have to say why they should not. It is an open-ended question. It's up to you. You might go for integrated reporting or against integrated reporting, but you have to give your points. Justify. Okay. Obviously, all the information that is there in the statement of integrated reporting information will give you information that is not there in the statement of cash flow. They will give you more information in the integrated reporting. Understood? Because statement of cash flow will not have all the kind of information that you require. You will not know the profit. You will not know the risk. You will not know the strategy of the company. All these are there in the integrated report. I'm just giving a brief so that it becomes easy for you to write the answer. This is for 9 marks. So you divide how much you're going to write under statement of cash flow and integrated reporting. Definitely under integrated reporting you can write more. Okay. Maybe out of 5, 4 marks you might get one for this, one for this, one for this, and one for this. For 4 marks and balance 5 marks you see goes for integrated reporting. Okay. So now, and you're writing it in paragraphs also. You see. So statement of cash flow. We all know they provide valuable information to stakeholders, but what do they exactly provide? That we need to know. See, cash flows are objective and you can verify. They are not subjective. You are not using any accounting estimates. Okay, so you cannot easily manipulate them also through accounting policy, like how you do in the statement of, like how you do with the profit. Profit, easily you can manipulate. Because to calculate that profit, you are calculating depreciation, which is based on some judgment, some assumption on the useful life, on the policy, right? Reducing or straight line. That's why profit through accounting policy choices you can manipulate, but cash you cannot. Cash, you know exactly this is the amount of cash. Why? Because you can go back and check the receipt and the payment voucher. Go check the invoice. You can always check, always verify, and it's objective also. So it's easily understood. Something which is objective and can be verified, easily understood. Then profit. One benefit is that. Second, cash that you are generating from operation is an indicator of what is the quality of the profit that is generated by the business. Higher the amount of cash generated from operation, the better the quality of profit. Okay? Because see, operating activity is something which is recurring. That is your like sole income is from that area, operation. You don't have to concern so much about investing and financing, whether you are having an inflow and outflow. But from operating, yes. Okay? Because if you're having a good quality profit, they will generate cash. Good quality profit. The profit could be a bad quality also, maybe short term, but it will not give you so much of cash. But good quality profit will generate cash faster and for a long term. And because of that, financial adaptability of the entity will increase. Financially, you will become more adaptable. Third, predictive value. Through cash flow, you can predict, which will help the stakeholders in the future to invest. They can check on the amount, the timing, the degree of certainty. It will help them to make some judgments at least on the future cash flow. Based on the today's cash flow, current cash flow, they can predict future cash flow. Not exactly, but somewhat up to some extent. Next. These are some advantages. You need to give disadvantages also. Always start with the advantages, the benefits first, and then the disadvantage. Okay. So now, however, the word however is a connecting word. This will tell you that you are now going to talk about disadvantages. You don't have to write advantages or disadvantages. The word however, but these are, what do I say? Negative kind of, it gives you a negative vibe. You understanding? It's not a positive, it's a negative word. But all these are okay, but you know, this happened. However, these things are there. So, however, but, even though, these are negative kind of words. Okay, so this are connecting words. If you use this, it is understood that you're talking about disadvantages. Easily you can write. So The adjustment of non-cash flow items within operating activities is complex. See, before coming to cash generated from operations, you have to adjust your profit before tax to cash flow, right? You have to convert, you have to do some adjustments. So that adjustments could be complex and it might not be easily understood also by many. So that's the disadvantages. And also the classification. The way you are classifying the cash flow in operating, investing, and financing could be manipulated. For example, something which is according to the standard should go under investing, you are putting it under operating. Why? To show more operating cash flow. Easily you can manipulate classification. So because of this, as such, it is only through an analysis of the statement of financial position and statement of comprehensive income and notes together get the cash flow that comprehensive understanding of entity's position and performance can develop. See, to understand the entity's position and performance overall, looking at the statement of cash flow alone in isolation is not a good idea. You can look at the statement of cash flow, but together with the profit and loss account as well as the statement of financial position and also the notes. Together, integrated way you have to look. When you're looking them together with the cash flow, then you can develop a full understanding of the entity's position. Now, we are moving to the integrated reporting section. This is very open-ended. Okay, you can write it in the numerous number of ways you can write this answer. But some basic points we can take from here. What is it? It is true that IFRS is extensive. Okay, they require disclosure which is very comprehensive. So because of this, there's a criticism that most relevant information are hidden in the immaterial disclosure. Okay. So because of this, an integrated reporting would increase disclosure. Correct? As well as imposing additional time and cost also on the reporting entity. Because of this. Because more you have to disclose, more time you have to give and more cost also. So this is like a disadvantage. Okay. One disadvantage maybe. So that's where they have started it. With a disadvantage, and now they are going to list all the advantages of integrated reporting. However could be a positive word also. If you have first started with disadvantages and then you are talking about advantages. Yes, I have told you that it's better to start with advantages first and disadvantages, but if let's say there is only one disadvantage where is five advantages, one versus five, then finish with that one disadvantage and then you can list all the advantages, or you could do it the other way around. First list all the advantages and then you can talk about the drawbacks also. But these are the limitations in integrated reporting. Like that also you can answer. It's your choice. Marks will not be cut for that. You will still get the same marks. I'm just telling you the ways you can write this question. Okay. But integrated reporting will provide stakeholders with valuable information. What are those valuable information which will not be immediately accessible from the financial statements? Non-financial information. Non-financial informations are not there in the financial statements. Okay. See, financial statements are based on historical and they lack predictive value. Through that, you cannot predict. Okay. They will be helpful for compliance purpose. That means you have complied with this law, this rules, you have applied it this way according to this standard, you have complied with this standard. For that purpose, yes. But other than that, they do not provide any meaningful information regarding the business value. What is the value of the business? They will not be able to tell you. This is only for the compliance purpose. We are talking about the financial statements. But the primary purpose of integrated reporting is what? Is what? To explain the providers of capital, how the organization generates value over time. The word is value. How they are generating value over time, whether it's short, medium, or long term. Providers of capital means who? They are explaining it to the user, to the lender, to the creditor, to the bank, to the shareholder, how they are creating value. Okay. How is this summarized? That they are creating value in integrated reporting? Your six capitals. Six capitals. Simply list your six capitals. The name of six capitals. Through six capitals, you can say. What are the six capitals? Financial, manufactured, intellectual, human, social, natural. Financial, your money, profit that you are getting. Manufactured, how much you're manufacturing. Intellectual, your IPs, your copyrights, your knowledge. Human, the staff, if they're very skilled, very talented. Social, the relationships and all are natural. Land, minerals, all these are six capitals, types of capital. Now, we are coming to the end. What does integrated reporting do extra? They examine the external environment also, which is not there in the statement of cash flow or other statements. They do this. Through this, you will know in what environment the entity is operating. Okay? And it also provides an insight into their resources and relationships. What are their resources? How are their relationships with the stakeholders to generate value will be there in the integrated reporting. It is principle based. So it should be driven by materiality. What is material? They will put in integrated reporting, including how and to what extent the entity understands and responds to the needs of its stakeholders. See, they will also put this also. How much the entity understands and how much they respond to the needs of its stakeholders. That is also there in the integrated reporting. So through this would include an analysis. Through this, you can analyze how the entity has performed within its business environment. Right? For example, if the competition is tough, against that competition, how your entity has performed, you can easily analyze it through integrated reporting because everything is there. What does the competition look like? How are they responding to their customer? How they are responding to their shareholder? Right? How they're taking care of their community, the social responsibility, all those things. Okay? Together with the description challenger for future. Definitely there will be some challenges for the future which also will be known to you through integrated reporting. It is the strategic direction which is lacking from the traditional set of financial statements. You have to compare. Basically, what are you doing? You are doing a simple comparison of integrated reporting versus financial statement, traditional financial statements, like statement of cash flow, statement of profit and loss, and all those things. Why integrated reporting is better and how and what type of value it can provide. That's what you are answering. So there is no strategic direction in traditional set of financial statements, which is there in the integrated reporting. It's lacking. Okay, and will be invaluable to stakeholders. So, but this kind of strategic direction is very important for the stakeholders. It's invaluable. It's needed, which is lacking. And to make a more informed assessment of organized purpose. Because of this, if they have a strategic direction, they can make more informed assessment as well as its prospect. They can assess the company better and make a decision whether to invest in this company or not. Right? So that's it for the last question of SBR revision kit. So I have completed what I have promised to you that before your December exam, I'll be covering all the SBR revision kit questions. Now all my SBR lectures are out under the SBR playlist, SBR lecture playlist. Coming to SBR revision kit, I will be updating it today. So you will be getting all the questions in a playlist, SBR revision kit solutions. And there are three important playlists for SBR. One is lecture, one is revision kit solution, the other one is the revision series that I have covered it for the September exam. You can use the same for the December exam also. Okay, it's beneficial. I think it was I think there are 40 videos. 40 videos are there under that playlist, short videos. I have covered all the standards from starting from IFRS 1, IAS 1 to current issue, right? All the IFRS, IAS standards are covered, then IFRS SMEs are covered, then current issue, analysis and interpretation. All the lectures are there. I've covered revision series, revision kit, and lecture. So make sure that you go through the three playlists. Okay, another question which before I wrap up this SBI revision kit session, I want to just remind you of this few last moment things that you need to do. If some of you just have 20 days or 25 days before the exam, you are not finished the SBR lecture, you still have a hope. You still can go through my SBR revision series, which is a small videos, very important points I've highlighted in each standard. You can go through that. That shall help you to cover the syllabus of SBR. If not extensively, if not wholly, but at least somewhat you will cover. So with that, try to do some questions, try to do some past papers, and that shall help you. So I'll be ending this. I will not be doing any more questions I've done in SBR. So for your December session, I will not be uploading any more videos on SBR because I have done with it. But if you have any doubt, you can always contact me through my social media. You know my email address, my Instagram, Facebook, WhatsApp, or you can even comment on my YouTube channel. I will be responding to you as soon as possible. So till then, take care and best of luck for SBR. Do lots of revision kit questions, do lots of past papers, and best of luck for your SBR exam.